All right, welcome to this explainer. Today, we're going to dive deep into the actual mechanics of the economy to uncover why things are really so expensive right now. We're going to look right past those daily news headlines to get to the structural truth of what is actually happening with our money. So, what's the actual math behind all this madness? Well, let's find out.
Right now, it's incredibly easy to just blame inflation on recent conflicts in the Middle East, right? It's a clean, 5-month-old story with a super simple cause and effect that you could practically draw on a napkin. But that narrative falls completely apart when we actually look at the data. It turns out we aren't dealing with some quick 5-month hiccup. No, we're dealing with a massive 5-year-old structural problem that has been quietly building up right beneath our feet.
And here is the number that exposes the whole illusion. 63. For 63 consecutive months, that's over 5 solid years by the way, the Federal Reserve has completely missed its inflation target. And they don't even use the headline numbers you see on the evening news. They use a specific scoreboard called the Personal Consumption Expenditures, or PCE. And right now, that scoreboard is sitting at over double their target.
So if our entire financial system is anchored to this 2% target, we really have to stop and ask, why 2%? I mean, why didn't they just aim for zero inflation so things stop getting so wildly expensive altogether? It didn't just fall out of some impossibly complex math equation. Somebody actually sat down and chose it.
Well, think of it as two pretty dangerous extremes. If we have 0% inflation, interest rates essentially sit right on the floor. So when a recession inevitably hits, the Fed is structurally trapped. They have literally zero room to cut rates, which can easily turn an ordinary downturn into a full-blown depression. But on the flip side, if you push inflation up to 4%, prices will double every 18 years, which completely destroys long-term contracts. So 2% became the so-called Goldilocks number. It's high enough to avoid a trap, but low enough that you barely even notice it.
And for a long time, hitting this 2% target looked absolutely effortless. From 1985 all the way to 2007, an era economists literally call the Great Moderation, the inflation pendulum seemed to swing perfectly back to the center all on its own. Growth was steady, inflation was low. But there was actually no invisible hand regulating it naturally. Someone was secretly standing right beside that pendulum, giving it a firm pushback toward the middle every single time it swung a bit too far. To understand exactly how they used to push that pendulum, we've got to rewind back to the late 70s and 80s and look at the famous Volcker playbook. Back then, inflation was absolutely sprinting at 13.5%. So Paul Volcker took over the Fed and deliberately drove interest rates up to a truly staggering 20%. I mean, really think about that, 20%. He intentionally triggered 2 back-to-back recessions just to essentially strangle the money supply. And you know what? It worked beautifully. He dropped inflation down to under 2%.
Now, you're probably wondering, why don't they just run that exact same playbook today? Well, because the game board has completely changed. Volcker's America had a national debt of about 25% of its GDP. Today, our national debt sits at roughly 100% of our entire economic output. So when Volcker raised rates, it acted as a very clean brake pedal for the economy. Today, trying to do that exact same thing causes a massive compounding problem.
Because of our massive debt today, the Fed is essentially pressing 2 pedals at once. On one hand, they hit the brake, raising rates to make loans pricier and slow borrowing down. But simultaneously, their foot is quietly pressing the gas pedal. Why? Because since rates are higher, the government now has to pay out massively more in interest on the money it already owes. And let me tell you, that gas pedal is completely floored right now. This year, an astonishing 19 cents out of every single tax dollar collected by the federal government is instantly swallowed up just to pay the interest on our national debt. Just in a few short years since 2021, when it was at 9%, this chunk of your tax money going solely to interest has more than doubled.
Let's actually put that into an absolute dollar amount, because the scale is just staggering. That 19% translates to over $1 trillion a year in net interest. We literally spend more right now just paying interest on our debt than we spend on the entire US military budget. And that $1 trillion doesn't just vanish into thin air. It gets handed directly back to investors, pension funds, and banks, pumping right back into the economy. Now, as wild as all this sounds, it's actually not a new revelation. Way back in 1981, economists Thomas Sargent and Neil Wallace predicted this exact trap. They warned that if the government never runs a surplus, the central bank actually cannot make the debt smaller. All they get to decide is if the debt takes the form of cash floating in the economy or bonds held by investors. If you squeeze the cash supply to fight inflation, well, the bond supply has to grow.
So here is the trap in motion. First, the government runs a constant deficit. To fight inflation, the Fed tries to squeeze cash. But because of that deficit, this forces the government to issue massive amounts of new bonds. Those bonds pay interest, which compounds the debt even further. Ultimately, when you actually look at the math, the Fed isn't fighting the root of inflation here at all. They're basically just guaranteeing a need to print more money later. They are simply postponing it.
Now, you might be looking out the window right now saying, wait a minute, gas is cheaper, the headlines are saying inflation is cooling. But guys, that is a dangerous illusion. Inflation works exactly like an earthquake. The headline numbers you read in the news, that's just the ground shaking. By the time you actually feel the ground shake under your feet, the fault line has already slipped deep underground a long, long time ago.
And the biggest reason for this massive delay between the fault line slipping and the ground shaking is housing. Housing makes up over a third, 35%, of the entire inflation basket. But it moves incredibly slowly because residential rents are usually locked in for a year at a time and reset in steps. So today's headline inflation reading is really just measuring pressure that was actually released many months ago. If you actually want to see the fault line slipping before the earthquake hits, you have to look at the money moving first. You have to look at M2. M2 basically tracks all the cash sloshing around within arm's reach of the economy. And right now, this supply is growing at over 5.5% a year, which is its fastest pace since the middle of 2022. Prices don't just magically go up unless there is more money to pay with. And right now, the money is definitely moving.
So who exactly is pumping this money in? The whiplash here is just incredible. In 2020, they used quantitative easing to literally pump trillions of dollars out of thin air to keep the system alive. Then, in 2022, when inflation caught fire, they tried to vacuum it all back up and successfully drained about $2.2 trillion. But then, in late 2023, they quietly went back to the closet, plugged the printer back in, and resumed buying $40 billion in bonds a month just to keep the system from breaking.
And all of this mechanical maneuvering by the Fed brings us right back to one glaring structural reality. We are currently running a massive $1.4 trillion deficit, which sits at a staggering 5.8% of our entire economy for this fiscal year. That is incredibly far above our 50-year historical average of just 3.8%. Basically, we've been spending way more than we bring in for a quarter of a century now.
Which really forces us to confront the ultimate question here. The math is crystal clear, but how do we fix a system where the incentives are completely broken? Neither political party is incentivized to campaign on spending less money. Regardless of whether you lean left or right, nobody successfully builds a political career by promising voters they're going to give them less.
Honestly, perhaps the most direct answer comes from legendary investor Warren Buffett and his famous 5-minute deficit fix. He said, pass a single law barring every sitting member of Congress from re-election anytime the deficit runs past 3% of GDP. Now, whether you think that idea is way too extreme or maybe not extreme enough, it leaves us with a really provocative thought we all need to ponder. What is it actually going to take to finally fix the political incentives in this country before the unbreakable math of a $40 trillion debt finally catches up with us?